two households, both living on exactly $60,000 a year in retirement. The first is a couple. Two Social Security checks bring in $49,700, and a small pension adds the other $10,300. Every dollar arrives on the first of the month, whether the market is up, down, or closed. The second is a couple with one Social Security check of $24,850 and an $875,000 portfolio they draw $35,150 from, same $60,000. But 59% of it depends on what the market did this year. Now put both of them in a year, the market drops 30%. The first couple's income does not change by a dollar, and they take the grandkids to the beach as planned. The second couple has to decide whether to sell $35,000 of investments at a loss or cut their spending, and they make that decision again the following year and the year after that. Same income, same level on any chart we'll ever see, completely different retirement. So I'm giving you two numbers at every level in this video. The dollar amount tells you which level you're in. The share that's guaranteed tells you what living there is actually like. Your level is set by the amount. How that level feels is set by the composition. I'm Mike, a regular guy who reached financial freedom on an ordinary income. This channel is where I explain the money stuff nobody ever sat us down and explained, the way I'd explain it to a friend across the kitchen table. If that's your thing, hit subscribe. Level 1 runs from about $25,000 to $30,000 a year for a single retiree, and Social Security isn't part of the foundation here. It is the entire foundation. The average retired worker's benefit in 2026 is $2,071 a month, or $24,852 a year. And at this level, that's essentially the whole income. The guaranteed share is close to 100%, which is the one genuinely good thing about it because every dollar is inflation adjusted and cannot be outlived. The problem is that every dollar is also already committed. The 2026 Medicare Part B premium of $202.90 comes out of the check before it ever reaches the bank, so the deposit is smaller than the benefit letter said. What's left covers housing, food, utilities, and prescriptions, roughly in that order, and there's very little behind it. What defines this level isn't the amount, it's the absence of shock absorbers. A $900 transmission repair isn't an inconvenience. It's an event that reorganizes the next 4 months. The dental work waits. The hearing aids wait. The grab bar in the shower waits. Two things move a household off this level, and both are underused. The first is the benefits you already paid for. Medicare savings programs can cover that Part B premium entirely. Extra Help reduces prescription costs, and SNAP covers groceries. Millions of eligible people never apply, often because it feels like charity. It isn't. You funded these for 40 years through payroll taxes, and collecting is not the same as receiving. The second is the claiming decision itself, which for this household is worth more than any investment they'll ever make. Claiming at 62 locks in about 70% of your full benefit permanently, while waiting to 70 gets you 121%. On the average benefit, that's $1,450 a month versus $2,568. For a household where Social Security is the whole show, that single choice is the difference between Level 1 and Level 2 for the rest of your life. Level 2 runs from about $30,000 to $50,000 a year, and it's Social Security plus a modest nest egg, which for a couple often means 2 average checks with a little on top, usually somewhere between $50,000 and $200,000. Here's where the second number starts mattering. A single retiree with $24,852 of Social Security and $150,000 invested might pull $6,000 a year, giving them roughly $31,000 with an 80% guaranteed share. That sounds fine. What makes this level distinct is not the arithmetic, it's the behavior. At Level 2, withdrawals aren't planned. They're reactions. The furnace fails, so $4,000 comes out. A medical bill arrives, so $3,000 comes out. The retirement account is functioning as an emergency fund with a tax bill attached, since every dollar leaving a traditional account counts as ordinary income in the year you take it. And that reactive pattern creates the specific danger of this level. Suppose the roof needs $12,000 and the market just dropped 15%. You sell anyway because the roof doesn't wait for a recovery. Those shares are gone, and they're not there when the market comes back. Do that twice in the first few years, and a portfolio that should have lasted 30 years quietly empties in 18. That sequence of returns risk, and it does more damage at this level than at any other. Because the portfolio is small enough that a few forced sales matter enormously. The fix isn't a bigger pile. It's 1 to 2 years of expenses in cash, held separately, so a bad month never forces a sale on a bad day. That single buffer is what converts a reactive retiree into a planning one, and planning is the doorway to level 3. There's also a decision at this level worth 30 seconds because it quietly determines your medical exposure for the rest of your life. When you enrolled in Medicare, you chose either Medicare Advantage or a Medigap supplement. Many Level 2 households chose Advantage because the premium was zero, and zero is compelling when money is tight. That zero isn't free, though. It trades a lower cost today for copays and out-of-pocket exposure later, precisely when your health is worst. Medigap costs more monthly and smooths the shocks. Neither is wrong. And switching from Advantage to Medigap later can require medical underwriting in most states, which is the part nobody mentions at enrollment. Level 3 runs from about $50,000 to $75,000 a year. And it's the most important level in this video because it's where the character of retirement changes. This is the point where your guaranteed income covers your essential expenses: housing, food, utilities, insurance, healthcare, transportation, all paid by money that arrives on the first, regardless of markets. The portfolio funds the extras. Planners call that your income floor, and a generation ago, your employer built it for you automatically through a pension. Today, most private sector workers get a 401k instead, which means you have to build the floor yourself, deliberately. And nobody tells you that's the job. Here's what the two numbers look like at this level, and it's where the composition point becomes undeniable. Take a retired teacher married to a retired firefighter with $350,000 saved. 2 pensions plus 2 Social Security checks bring in $68,000 a year, of which roughly $62,000 is guaranteed. So, their guaranteed share is about 91%. Now take the couple next door with $1.4 million in an IRA and Social Security. They're also around $105,000 of income, but only $49,700 of it is guaranteed, so their share is 47%. On a net worth ranking, the second couple is 4 times wealthier, month to month. The first couple never once has to decide how much to sell or worry about what the market did, while the second makes that decision 12 times a year for 30 years. Your level is set by the amount. How that level feels is set by the composition. Now the part that most videos skip, which is how you actually climb from where you are to level 3, because it doesn't require saving another dollar. You climb by converting savings into income you can't outlive, and there are exactly 3 ways. The first is delaying Social Security, which adds roughly 8% per year of waiting between 62 and 70. Guaranteed for life and adjusted for inflation. There's no product to buy and no salesperson attached, which is why it's the best deal available and also the least marketed. The second is converting a slice of savings into a simple income annuity, and I mean a slice size specifically to lift your guaranteed income just above your essential expenses, not your whole nest egg. The third is removing a large fixed expense, usually the mortgage, which lowers the floor you need rather than raising the income to meet it. And there's research that explains why this matters beyond the arithmetic. Blanchett and Finke published a study in 2024 called Guaranteed Income, a License to Spend. They found that retirees holding wealth as guaranteed income spend roughly twice as much annually as retirees with the same amount of wealth sitting in investments. Same money, double the actual living. In a survey inside that research, 60% of people said they'd feel more comfortable spending on non-essentials with an extra $10,000 a year of lifetime income than with an extra $140,000 in savings, even though those are worth about the same. That's what the composition number is really measuring. A guaranteed paycheck doesn't just cover your bills, it gives you permission to use your own money. Before we go higher, 2 things can knock a comfortable household down a level overnight, and both hit hardest at levels 3 and 4. The first is what happens when one spouse dies. The household keeps the larger of the two Social Security checks and loses the smaller one entirely. So a couple at $49,704 drops to $30,816 if the higher earner was the survivor, and to $24,852 if not. Meanwhile, the property taxes, insurance, and utilities don't change at all, and the survivor now files as a single person, in brackets roughly half as wide. So the same income gets taxed harder and more of the Social Security becomes taxable. A comfortable level 4 household can become a level 2 household in a single month. The planning is specific rather than vague. Get the pension survivor election right when you elect it, because that decision is usually irreversible. Have the higher earner delay Social Security, since that's the check the survivor keeps. And run your numbers once for the household and once for a single survivor, because that second calculation is the one that reveals whether the plan actually holds. The second landmine is long-term care. Medicare does not cover it. Skilled nursing runs around $9,700 a month in 2026, and a few years of it can drain a level 3 or 4 retirement to the studs, frequently leaving the healthy spouse with far less than they planned on. You have real options if you decide before you need them, including a dedicated pool of savings, home equity, a traditional or hybrid policy, priced in your late 50s, or planning around Medicaid with its 5-year look-back on gifts. The mistake isn't picking the wrong option. It's having no answer and discovering that at the worst possible moment. Level 4 runs from about $75,000 to $120,000 a year, and a defining feature is 3 or more income streams arriving on schedule. A typical household here might have $3,600 a month from 2 Social Security checks, $2,400 from a pension or annuity, and $1,800 from plan portfolio withdrawals, which totals roughly $93,000 a year, with a guaranteed share around 77%. To reach the top of this level without a pension, a couple needs roughly $1 million invested, which is why most households arriving here either have a pension or spent 30 years maxing accounts. Notice the word planned, because it's what separates this from level 2. Withdrawals here follow a system rather than an event. It might be a fixed percentage annually, or a guardrails approach where you pull back somewhat after a bad year and take a raise after strong ones. The money shows up on a schedule because someone designed the schedule. This is the level where retirement stops being a math problem and becomes a life. It's also where a new problem starts, and it's one most people would happily accept. Level 5 runs from about $120,000 to $200,000 a year, and the question flips from, do we have enough to how much of this do we keep? 3 tripwires define this level. The first is IRMA, the Medicare surcharge that begins in 2026 when income crosses $109,000 for a single filer or $218,000 for a couple. It has 2 unpleasant features. It uses a 2-year look-back, so your 2026 income sets your 2028 premium, which blindsides people who had one high-income year. And it's a cliff rather than a ramp, meaning $1 over the line triggers the entire tier for the full year. The second is required minimum distributions, which begin at 73 for most people and force money out of tax-deferred accounts, whether you need it or not. On a $1 million traditional balance, the first year's required withdrawal is about $37,700, and on $2 million, it's about $75,500. Those forced withdrawals can push you across an IRMA line and drag more of your Social Security into the taxable column. The third is the interaction between those, sometimes called the tax torpedo, where an extra dollar of income triggers more than $1 of tax consequences. At this level, the order you withdraw from accounts, generally taxable first, tax-deferred second, Roth last, can change your lifetime tax bill by 6 figures. And here's the opportunity most people at this level miss. The stretch between the day you retire and the day required withdrawals begin is often the lowest income period of your adult life. Converting traditional money to Roth during those years, at rates you'll never see again, is how you diffuse the torpedo before it goes off. That window is finite and it closes on a schedule you can predict, which is exactly why it should be planned rather than discovered. Level 6 is $200,000 a year and up, and something structural changes here. the principal stops shrinking. Households at this level generally live on what their assets produce rather than on the assets themselves. Dividends, interest, rental income, and business distributions cover the entire lifestyle. To generate $200,000 a year at a safe withdrawal rate takes roughly $5 million invested, though many households here reach it through a business, real estate, or concentrated equity rather than through a portfolio alone. Social Security still arrives, and it's close to a rounding error. If it stopped tomorrow, nothing about their life would change. The work at this level isn't spending. It's everything around spending. Trusts that move assets to the next generation without probate. Qualified charitable distributions, which let you send up to $111,000 per person directly from an IRA to charity in 2026, satisfying required distributions without the money ever appearing as income. Annual gifting to children and grandchildren. And Level 6 has its own weak spot, which is concentration. A household drawing $200,000 from 8 rental properties in one town is far more fragile than one drawing the same income from properties in 8 different markets, or better still from a mix of stocks, bonds, and real estate. Identical income on paper, wildly different durability when one local economy softens. There's also a problem at this level that sounds like a joke to everyone below it and isn't. A large share of these households never actually increase their spending. They arrived here through 4 decades of saving, and the habit doesn't switch off because a threshold was crossed. So they generate $200,000, live on $90,000, and the balance keeps climbing toward an estate they never consciously decided to leave. If that's the intention, it's a fine outcome and worth planning properly with trusts and gifting. If it's just momentum, it's 40 years of postponed living that never got unpostponed, and no amount of additional income fixes it, because the constraint was never the income. So let me pull the whole thing together, because the pattern across all 6 levels is the same one. The amount determines your level. That's what the chart measures, and it's a real thing. But at every single level, the households that sleep well are the ones whose income was built on purpose rather than assembled by accident. A floor of guaranteed money underneath the essentials. Streams that arrive on a schedule someone designed. Taxes handled deliberately, and the 2 landmines planned for years before they land. That's why I've given you 2 numbers at every level. Somebody at level 3 with a 90% guaranteed share is in better shape, functionally. Somebody at level 4 with a 45% share, even though the second one ranks higher and would say so at a dinner party. The chart can't see that. Your kitchen table can. Here's your one job after this video, and it takes about 10 minutes with a calculator and a bank statement. Work out both of your numbers. First, add up everything that arrives in a month, meaning Social Security, any pension, and what your portfolio realistically produces, which is roughly 4% of the balance divided by 12. That total tells you your level. Second, add up only the guaranteed pieces, meaning Social Security and any pension or annuity, and divide that by the total. That percentage tells you how the level feels, and it's the number almost nobody has ever calculated about their own retirement. If it's high, the market can do whatever it likes and your life doesn't change. A low number tells you exactly which of the 3 climbing moves to use, and you can be at the same income level next year while feeling like a different person. Your level is set by the amount, and how that level feels is set by the composition, so find out what yours is actually made of. If this was useful, hit subscribe. This is what I do every week. Plain English, nothing to sell you. Next video, uncovering the single move that raises the guaranteed share more than anything else available to you, which is exactly when to claim Social Security. 62, 67, or 70, the break-even math most people get backwards, and the specific situations where claiming early genuinely is the right answer. I'll walk you through how to decide for your own life. I'm Mike. I'll see you in the next one.